Right, good morning, and thank you all for joining us today for our first Business Insights webinar series of the year. Here with Kurt Spieler and our panel of experts, Stacy Amon and Doug Sutko, to discuss the 2022 investment outlook. My name is Chriselle McNeil, and I'm joining here today to help move us through the presentation and gather questions from you as our panel provides their thoughts on the economy and market. We hope you've all had an opportunity to read through this year's outlook. And if so, you'll notice Kurt will be discussing it in a slightly different format. First, he'll go over the positives in the economy, then discuss the risks we see in the economic outlook, followed by our portfolio strategy. Now, throughout the presentation, we'll be addressing questions from the panel here in the room and gathering questions from you in the audience through the Q&A function located at the bottom of your screen. At this time, I'd like to invite the folks joining us today to say a bit about themselves.
Thanks, Chriselle. My name is Stacy Amon. I'm part of the investment management team here at FNBO. I've been with the bank for about 20 years. My role is overseeing our client portfolio management team. So those are the members of our investment team that work directly with our clients, setting up investment strategies and investment objectives. Also, as part of the investment team, I serve on a variety of committees. I serve on our asset allocation committee, our mutual fund selection committee, and also our alternatives committee. With that, I'll turn it over to Doug.
Hi, my name is Doug Sutko. I hardly consider myself an expert on the economic outlook here, but I do feel I have a good representation for the customers that we serve. I'm Managing Director of Community Banking here in Omaha and Lincoln, and appreciate you all taking time to join us today.
Thank you both for being here. We look forward to your insights throughout the presentation today. With that, I'll turn it over to Kurt to begin.
Thank you for joining us today. As Chriselle mentioned, I'm the Chief Investment Officer, ultimately responsible for investment strategy as well as this presentation. So we hope you find it informative and interesting, and wanted to also encourage the Q&A chat session that we're going to do just to make this more of a conversation as compared to the typical Zoom call. Having said that, I am going to start with a few economic slides just to set the macro environment in which that we're managing today. What this first chart shows is the U.S. economic growth from 2021 on a quarterly basis. What's unique about last year is growth on average was around 5%, well above the 2% trend line that we've been seeing for much of the last decade. You do see some variations with stronger growth, in particular in the first half of the year, as well as weaker growth in the third quarter as the U.S. economy is dealing with some supply chain disruptions and other issues. But overall, we would characterize this as a lot of positive momentum as we're entering 2022. Whenever we review the U.S. economy, we start with the consumer as it represents almost 70% of economic growth. If you look at how the consumption has been occurring here, this is a chart that shows personal consumption expenditures for both goods as well as services over the last 5 years. To briefly define goods, we include both durable goods, which would be autos, appliances, furniture. Non-durable goods would include food, fuel, or energy, as well as clothing or apparel. The services area includes childcare, education, would also include travel and leisure, so some of those activities. That historically has moved in pretty much in sync, as you can see from the years 2016 through 2019, but you notice a big split in terms of the performance of those areas during the COVID and the areas surrounding COVID. So individuals' consumption pattern changed to certainly spend more on goods as compared to services.
So Kurt, so often, I guess I'm going to interject, and again, I appreciate what you said in the front end, and I failed to mention it. Please, those on the Zoom, please interject, interrupt. We want this to be collaborative. It makes it way more comfortable for us on this side, and I think much more informative for those on the call. But you had just talked about U.S. consumption being a primary driver, perhaps of the situation we're in, and that situation being inflation, which I know will come up later on. We so often hear about supply side issues in the supply chain, obviously a product of just consumer demand as opposed to limitations on production. And obviously it's relative.
I think it was both, but maybe what is not out there within the media attention is how much of it was demand driven. So if you look at, I mentioned that consumption patterns changed, look at the spike that we saw in goods. So when people were actually saving money during this COVID downturn, and then changing the consumption to spend more on goods. And so you had a lot of companies seeing 20 to 30% demand for their product, which, historically they were maybe seeing, 5 to 10% demand. And so you had a number of goods. So that led to that demand supply imbalance. And certainly that was part of the inflation. So we would characterize it. It wasn't just supply chain. It was actually unexpected demand for a lot of these companies coming from consumers. When we evaluate whether that will continue in terms of the demand participation, we look at it, how are consumers looking from a balance sheet perspective? What this chart shows is household debt payments as a percentage of income over the last 15 years. And consumers in general are much more financially healthy than they have been in years. And so their overall debt payments is 9% of their income. That's down from the 15-year average of close to 11%. And significantly lower than the 13% level that we were experiencing here in the late 2008, 2009 timeframe. So this has been a unique recession in that the savings rate increased during this particular recession and the subsequent recovery last year. So individuals have cash, in the banks, deposits, money market accounts, and so you're certainly seeing, a lot of cash availability to spend as a result of the pay down. That's part of the lower interest payments is you did see consumer debt, credit card payments come down during the time frame. The other aspect is if consumers have, are financially healthy is, what's going on from the income standpoint and the amount of jobs being created. What our next chart shows is the total unemployed workers here in the US over the last 5 years. You see the spike during the March-April timeframe of 2020, a fairly rapid recovery and then consistent growth. So the number of total unemployed workers right now is 6.3 million. It's a little bit higher still than the January, February of 2020, but you're seeing significant growth in employment. Overall, the unemployment rate would be 3.9% versus the 3.5%. Most economists would characterize this as being fairly close to full employment. What are individuals spending their money on? Housing is certainly a piece of the story. And it's not just housing, that goes back to the appliances and furniture and the goods demand that we previously cited. In terms of, will this continue? Are we in a housing bubble? That's a frequent question that we get. If you look at it, the home ownership rate, so once again, starting with demand, home ownership rate at 65% is still well below the 2005, 2006 area when home ownership rate experienced 69%. If you look at the supply, you've seen supply growth over the last few years, but in general, we would characterize the housing market as supply continues to not keep up with demand. So you're still seeing in most markets low inventories. Because of that, you've seen a significant price appreciation in the 19 to 20% area for the housing market.
When you look at that, a couple of factors. Doug brought up a question earlier about inflation. You talked about increasing prices. Mortgage interest rates have started to climb. Mortgage rates are probably 50 basis points or so off their low. Can this trend continue with kind of those factors in place?
Yeah, good question. The way we would characterize is further modest increases of interest rates. We think the demand, supply, and the housing fundamentals will stay. And the housing market will continue to, either stabilize in price or see some slight price appreciation. The risk, as always, with interest rate sensitive sectors such as housing is a spike in interest rates. So if we experience in the U.S. another climb in the interest rates by, let's say, between 0.5% to 1% from here, I think that would be more difficult for the housing market to stabilize. So from our perspective, the fundamentals are in solid shape. This is a lot different than 2008 and 2009, less speculation. Affordability is still better than it was, 12 years ago. from that standpoint. But yeah, there's still risk. It's also regional, as we all know. Housing is a local as well as a regional phenomenon. So there is some differences with the West in particular being a little bit more expensive and less affordable. The Midwest actually being one of the more affordable areas from a real estate perception. So we think it can continue, but interest rates have already picked up this year. The 10-year Treasury, for example, hit 187 here this morning, up from the 140 level. So you're starting to see that, and that will maybe take the edge off that price appreciation in housing. Switching to the business area, what is companies doing? How are they experiencing? What this chart shows is the net profit margins for companies in the S&P 1500. So in essence, the 1500 publicly traded larger companies here in the US, but would also encompass mid and small companies. And what you can see is profits have never been higher. A number of reasons for that. We've seen strong revenue growth. That's led to operating leverage for businesses. We've seen productivity increase, as companies became more efficient and invested in technology. Low interest rates, low debt costs has been a piece of that net profit margin expansion. And then low tax rates. You can see the benefit from the tax reductions at the corporate level in 2018. That was the 2019 area. That's when you spiked up to the 11% range. I also think it shows the resilience of US companies, during COVID, work from home, just figuring out how to, continue to grow their business, grow their profits and cash flow, during this environment. So we were talking about this a year and a half ago. Just don't underestimate the ability of companies to, figure out how to make money, regardless of the economic and quote COVID environment that we've been dealing with.
When you look at this chart, like you said, we're at kind of peak profit margins. How much can that trend continue? And if we see a moderation in that trend, is that going to impact corporate earnings and thereby potentially, the stock market?
Yeah, the peak margin question, I don't think we're going to see an upward trend in margins from here. I think the risk is more to the downside. So if you look and talk to a number of companies, as we do in Doug's area, as well as within the investment team, what's hiding this net profit margin story is the amount of costs that have increased. So we're seeing in wages or worker compensation, you're seeing in cost of goods sold, inventories from that standpoint. And what you've seen so far, though, is revenue growth for a lot of companies. The average revenue growth for companies in the US S&P 1500 was in excess of 10%. So when you see revenue growth of that magnitude, that can offset some of that cost pressure. So the risk to us in the operating margins and the net margins is likely more that revenue growth slows enough, but you still have this cost escalation, and that could lead to a compression in margins. Why we wanted to bring up the corporate profitability chart is, to a certain extent, is what are businesses doing with their excess cash flow. In general, if you look at investment spending surveys, you're pretty optimistic, especially compared to November 2020. Back in November 2020, overall investment spending was expected to be 2% higher. It did turn out to be greater than that because of the huge growth that we experienced here in profitability last year. But now if you look at the recent survey for overall capital expenditures, 40% of companies are expected to invest more in their business as compared to a year ago. Where they're spending, and no real surprise, companies continue to spend on digitalization, work from home, automation, areas within information technology, spending to get more efficient, with 60% of companies planning to spend more in this area. So a lot of positives, I guess, our summary. The consumer's in solid shape from a balance sheet, cash levels, income. Businesses are profitable. They're reinvesting some of their capital within investment spending within technology. But we've kind of alluded to the risk already as we kind of started to talk to the presentation. So we want to talk about, what are the headwinds or potential issues within the economy, leading with inflation from that perspective. This chart shows the same GDP growth on a quarterly basis, but you can see the inflation in blue, and this is the consumer price index, we've seen a significant change from the first quarter. So for much of the last decade, inflation was sub 2%, with very temporary spikes in inflation. And that's really changed starting in the second quarter of last year and has continued through the fourth quarter. The latest number is 6.8%, and this is the Consumer Price Index. So we've continued to see higher levels of inflation. We talked about it being, demand-led in the goods area. What I think is the most concerning is that it's spread through various sectors. So it's not just a select number of autos or certain areas of goods, related to semiconductor chips. It's spread into many different areas.
It's certainly interesting to see the pace of inflation or inflation being at a higher number and then growth. Yeah, it's kind of the key of the day talking about inflation in the Fed and monetary policy. But I'm just curious. Early on, we used the word transitory a lot as it related to inflation. Bottlenecks on supply chain side issues. In your opinion, as you see it now, is it still transitory, or have we moved past that? And to what percent it is transitory? Do we see an end in sight and some, I guess, regression back down to quote unquote normal?
Yeah, we're coming out in terms of our view is that inflation's more now structural or going to be persistently higher than what we've been managing. There are some aspects of the transitory from supply chain disruptions. The automobile industry is one area that we cited. Semiconductor chips are lacking. That's led to, actually used car prices going up. You can sell your truck or your SUV for more if you bought it 3 years ago than the price that you paid for it new 3 years ago. So there's some unsustainable transitory part. A lot of people had expected improvement in the supply chain from the supply side in the first half of the year. We'll see with Omicron that might be impacting some of those bottlenecks that we've seen in the ships and warehouses in California from a shipping standpoint. So I think overall you'll see some improvement, that inflation will moderate, but from our perspective, it's become much more widespread in different industries, and it's not entirely related to the demand and supply argument that we've been talking about.
An interesting point, we had a presentation by T. Rowe Price and one of their economists, and they said, part of the solution to supply chain is moving more production back to the United States, less on international. And so that may have an impact too on, the price of goods, because, there may be different cost structures. Now, T. Rowe Price was talking about, is that in the US, is it in Mexico, but at least getting closer to shore. So, those ships sitting off the Pacific coast, there's goods here, it's just, getting it in.
Yeah.
So that's going to have an impact too on, what the longer term inflation story. So again, moderating from where it is, but maybe not down to the sub 2% level we've been accustomed to the last several years.
It's interesting too, the couple of the last points you made relative to corporate profitability. And I know that was an S&P chart, but I think it's kind of consistent with the clients that we serve here in Omaha and in our markets. And then obviously seeing the impact, seeing the inflation charts that we're seeing. I'm always curious to see what impact the government stimulus has put into both of those. The profitability, PPP, recording those as revenue and profits in 2021. The liquidity now that's on the balance sheet, no doubt of those S&P 500 companies, but also our clients. How much is that impacting this inflationary issue we're seeing today?
Yeah, and we'll talk about it here in a few minutes. We'll show the pivot in the Federal Reserve policy, but that's certainly been a contributing factor. So federal government deficit spending, for example, $3 trillion, last year, expected to go to $1.1 trillion based on current laws and what's been, approved, I guess, through Congress and, signed by President. So that's an aspect of it that's contributed. That's contributed to the savings with the additional checks, unemployment insurance benefits, PPP, from a business standpoint. So the world certainly, at least in the US, as well as what Europe and China and Japan have been doing, is flush with liquidity right now. And that's showed up in inflation. So if you talk about it, what liquidity means is you're trying to stimulate demand. And what we've just cited is, well, demand exceeded the ability of companies on the supply side. I think what Stacy was talking about is definitely true from that standpoint. It just takes time. And so that's one of the things, whether it's supply chain bottlenecks. I'm sure CEOs are talking to their CFOs saying, hey, we need more inventory. Just in time inventory worked great until it didn't work great, when we missed out on sales from that standpoint. So how do you source it in different areas? Do you pull production in? But you know, if the supply chain has not been working efficiently, then how do you make changes, you know, to that? And that just, it's not a 3-month or 6-month transitory thing. That's you cite changes like that over, you know, years from that standpoint.
And no doubt that's been a top of mind for our clients on the call is, you know, inventory forever was a 4-letter word. You know, it eats up your working capital, right? And now it's turned into a different 4-letter word, that being gold. And how do I preserve it and be able, you know, and make sure that I have the ability to execute and buy the products that I sell. I know inflation, economic growth, inflation, inventory, all that we're speaking about so far is very important to you all because I have these conversations with you as our clients. So again, an invitation, while we think we know a little, what we do know, what we do learn is from you. So please, another invitation to chime in, use the question and answer feature, or certainly if you're more comfortable, wait to the back end to ask your question. But at any time, please, we'd love to hear from you.
Yeah, and speaking of that, we just got one that came in along the supply chain issue and the persistent nature. Do we see it improving even in the kind of short to intermediate term? And you know, you talked about, you know, bringing on new capacity and the time it takes. So how do you see that kind of short to intermediate term on the improvement in supply chain issues?
Specifically, when's it going to open up?
Yeah. Crystal ball question early on. Go ahead with that. You know, it is, as everything else, it is industry specific. I would say that it's going to improve this year, but we're going to be dealing with supply chain issues as we head into 2023. So, you know, you've already started to see some signs in certain industries in the fourth quarter. Omicron, you might have a little bit of a delay, but overall, you know, I would expect some gradual improvement and it, you know, loosening it up, you know, as companies, you know, source as well as the rest of the world. So you're seeing capacity increases, you know, in China, other parts of Asia, Mexico. You know, so you will see some capacity coming online that will help alleviate it, but it's not short term, and you know that's just kind of a medium term.
Part of the question too was, you know, what are some of those causes? And I think part of that was, as you know, the original kind of COVID was spreading, there was a lot of manufacturing shut down. You know, China, Southeast Asia first, where a lot of that import of goods comes, and so there was times where it started with, well, production was shut down, so there was no goods being produced from partners internationally. Then it kind of hit the shipping and container business, the rails, the tractor trailer, semis, you know, drivers. So there's been a variety of things, and they've all just kind of added on to each other as part of kind of a root cause.
Not least of which is consumer demand, which
Yeah.
we opened up with.
Yeah.
The other part of the inflation story, and then we'll move on, you know, from our topic is, and why we think it's going to be stubbornly high. And this is something that we've been saying, you know, for years from that standpoint is you don't have inflation without wage inflation. So, you know, government periodically has been running massive deficits, but it hasn't showed up in inflation until now. And a big piece of that is what's going on with worker compensation. So what this chart shows is the employment cost index, which is what we use to look at wages, and then core CPI, which would exclude food and energy. And after moving between 2 to 3% for not just the last 5 years, but even longer, what we've seen is a spike up towards the 4 or 5%, you know, type level. The other interesting part that we like to watch here is for a period of time, inflation has exceeded wage increases. So real disposable income, and when we use the term real, it's just taking out, in this case, it's inflation minus, you know, wages were slightly negative. That's unsustainable in terms of an economic outlook or advance. We think that'll change. We do think inflation will moderate somewhat during the year, but we see, you know, workers being able to get, I guess you would say, price increase or wage increases as we go forward. A big piece of that story then.
I'm going to interject real quick because we did get a question. I think you touched on it, but the question was, can you comment about the impact of in real inflation adjusted wages? So I guess your last comment was you feel that will be addressed with increases in pay, or is that going to be a significant impact to the middle class or the ability to consume?
Yeah, a lot of the wage surveys that I see is somewhere around 4% wage hikes for this year. So where does inflation turn out to be? Core inflation right now is running slightly in excess of that. So core inflation has been running closer to 4 to 5% because part of the areas that you've seen the most inflation is, I mean, go to the gas station, it's energy prices, that's very volatile. Food, you've also seen food increases, which is unfortunate for lower income individuals. The reason why people cite the core, we all experience, we know we're paying more at the gas station, that sort of thing, is just to take out some of the noise and volatility from those two areas. So we all know, that we pay, at the gas station. So that's the question is if you are talking around 4%, and I think that's also industry specific. So I know if you talk to construction companies right now, they're saying inflation is not 7%, it's well above 10%.
Yeah.
And when I'm paying, even unskilled, workers in my company, the starting wages are well above 10%. So there's a lot of differences, and this is the average. What I think what we're saying is wages are going to stay high, but maybe because of that supply chain coming back online a little bit, that you're going to start to see maybe it turn more positive on a real income basis.
Yeah.
But income, the labor market's also important. We already showed the total unemployed workers. So this is a part of the story, and it's part of inflation, and in certain areas, seeing even more than 4% in wage hikes, is just the difference between total job openings, which is the green line, and then what we previously showed, the total unemployed workers. There's a $4 million plus gap. Most difference between jobs available and unemployed workers that we've seen, here in the U.S. This is a multi-layer, type issue. There's a lot of reasons for that in terms of the gap. Some of it is skill-based, not being able to find qualified workers for that position. Some of it is workers not wanting to come back, into the employment. Some of it related earlier in 2021 with the unemployment insurance benefits. So we think there's a multitude of reasons. One of the biggest reasons we would say is the labor force participation rate. And just to define that briefly, this is workers over the age of 16 that are participating in the economy, of employment age. So 16 to, I think they cut it off at 65. What you have seen, over the last 15 years is a decline in the participation rate, but you can see just before COVID hit, the rate was 63 moving towards 64% from that standpoint. So you're getting some people back in the workforce. What we have then experienced is the dip following the COVID, and then participation rate has stubbornly remained somewhere around 2% less than that 64% level. And this is, the variety of reasons. And this is, one of the areas where I think the Fed got wrong is they thought we'd go back to that, higher level of participation rate in the economy. But for a number of reasons, we've seen it significantly lower, that you have not seen workers come back into the workforce nearly as much, certainly, as economists expected.
It's interesting to me in seeing this data in that what's normal from a participation rate standpoint is the mid 60s. I thought, to me, that seemingly seems low. And so this drastic change that we're all seeing and talking about over coffee here is that 2% delta. That's surprising that would be that impactful in what's, creating this issue on labor. And then I guess my second question is, and I don't get this, you just talked about the cost of living is significantly higher. And yet we've got more job openings than we've ever had. My true question that I have, and I don't think I've gotten an answer for, we'll see if I get one today, is how are people affording not to work? I just don't understand that piece of it. And I'd love your thoughts on that.
I'm not sure I will have an answer, so I may duck that question. But let me put it, I want to put this in perspective. So what is 2%? Seems like a low number. That's 3 million people here in the U.S. So that's the amount of, which is, fairly close to the difference between job openings and unemployed. I want to answer it a little bit on an age and demographics, and then I'll come up with a theory, maybe not an answer, but a theory. So it's interesting to look at the data. So part of a big piece of this story is workers less than the age of 25 and greater than the age of 55. So what we experience is significantly above trend early retirees that have not come back. So this slight tick up in labor participation that possibly is related to the ending of the unemployment insurance, extra money being paid to stay home and not work. But that's not a significant piece of the lower participation. It's more that people over the age of 55 retired and they have no intentions, if you look at surveys, of coming back into the workforce. Similar with the younger employees, they have not been as aggressively coming back and participating in the market. The other side, demographics, if you look at it, men in general have come back into the workforce, and their participation rate is not significantly different, but you have seen women not come back nearly as much in the workforce. So the theory that we would ascribe to is people are in general feeling that they can live with, out that income. So if you're in a fairly low paying job and you're paying childcare, for example, why come back? You're not benefiting. So I think companies and families are coming back and doing more with less from that standpoint. So they're having to figure out, and they are figuring out how to live with their means. So I don't think there's like an easy answer. I think it's a puzzlement. It's been a surprise to the Federal Reserve. It's been a surprise to economists. And I think there's a number of reasons, Doug, for that. But people are just figuring out how to make it work. So will it continue to creep up? Because if you look at, if we're close to full employment, unemployment rate less than 3.9%, will this continue to at least move towards that, 63, 64% level? If we do, the sustainability, the magnitude of the expansion would certainly be positive and more robust in that area.
And I think another impact on that too, Kurt mentioned early on in the presentation about, savings rates went up as people were doing less of spending. So that's reflected itself in, as we've come back, people have spent more on goods, durable goods, but also savings rates have increased. And so the question is, okay, savings have been nice. We've gone a couple years, do people re-enter, maybe they see their savings decline over time, situations change, but the period of COVID and stay at home was some of the highest savings rates we've experienced in the United States. And so some of it could be just, we've got a little nest egg here, maybe we want to, have just one spouse working or one person in the household working instead of two. So
It's interesting. There's a question here online that asks a specific question that maybe you haven't touched on. There's a myriad of things that cause maybe people to be more comfortable staying at home. It might be government intervention. It might be just an ability to live within your means. One specific theory would be childcare. And this specific question says, have the childcare supply issues impacted the women and families that aren't going back to work?
Yes, I think that's been an impact. So the other areas that you see, childcare is clearly one of them. Elderly care, do you want your aging parents and grandparents and, in nursing homes or staying home and taking care of it? So yeah, there's all sorts of reasons, but yeah, childcare has not been opened up. That's an area that is experiencing worker shortages, in terms of, from that standpoint. It's also interesting to watch the whole stay at home, and that has momentum, which has an impact on office space from that standpoint. So companies have switched to either a hybrid, model such as what we've done, here at FNBO, but you've also seen, experiences there that can you work out of your home, and that's had an impact as well.
I would say, for years as we meet with our clients, the source of discussion or frustration is taxation. It might be government, it might be political in nature. I would say taking over regulation might be an issue, but taking over the discussion over the last year and a half has been labor supply issues. And so this is very relevant. So continue to ask your questions or comments to the panel as you have them. And it's funny that I think what's slightly taking over now in lieu of the labor discussion, not that the labor issue has gone away, is in fact inflation. So I think we're on point here with these two subject matters.
yeah, one of the questions that came in too, and we've done several of these presentations, is the generational gap, experienced older workers retiring, new workers coming in, the education gap, the skills gap. That's a factor also on when you're looking at there's a mismatch on job openings with the quality or the skills needed from those employers or those employees.
Yeah,
I like the comment in there too. Customer of mine made the comment that a lot of people are avoiding college because you're not going to get that.
Yeah.
What I think was a significant value proposition, the college experience.
Yeah.
And so if it's from home on your computer, you'll forego that opportunity.
Yeah, it's been interesting to watch employment or enrollment within colleges, both junior colleges as well as your state colleges in general is down. So you think, well, if there's not jobs and opening, go to school, get training. So that's that skills mismatch that I think that, we're experiencing. Turning just briefly to economic confidence, this includes the consumer confidence, and you can see that, decline here from, the pre-COVID area, then you did get a little bit of a bounce back there overall. But in general, we're not near the peaks, although we're not near where we were in the 2011 through 2014 area. But small business optimism has also, it didn't see as much volatility, so you didn't see the spike up that consumers became more confident as compared to small businesses. But you've kind of seen almost a gradual trend down here since 2017 area in terms of overall confidence. And I think there's been some changes within that, but I think Doug, and you had a great observation as we were preparing for this meeting to maybe share with people.
I would. In fact, we got a question, I think, that is lockstep with my thought or my comment or my theory, I suppose, is the question is interested in hearing your comments about inflation expectations and the impact of inventory supply stockpiling by businesses as they struggle to keep up with increased demand and other competitive pressures. And it's, and again, hearing from you all, I think, it used to be about trying to gain market share and to perform on that. I think now the issue is how do I execute the market share that I have? And there's risk to being able to get the components that I need, the raw materials or the labor to perform on the service I provide. So I think that confidence is interesting to me because I think there's the work is there, but the ability to execute is maybe in jeopardy. So I'd love to get your thoughts on that. And certainly the business owners or leaders within the group, please opine or please contribute to this discussion because I think it's really relative.
Yeah, and I agree with that statement and what's coming in, because what we hear periodically is that it's not a demand problem, here. We have the demand, but do we have worker shortages? I mean, 53% of companies are trying to hire workers right now, are saying they're going to increase their workforce, for example. So they're trying to, catch up with demand. The reality is why do you get inflation, in general, or why are companies able to increase prices is because demand exceeds their supply. So if you had 20 to 30% demand growth and you had for a while, as Stacy mentioned, the inability to access supply, maybe it's, easing up a little bit, you have more supply, but you're still not keeping up with demand. So then you can raise prices until, the demand, you see the impact in demand, you can, no longer raise prices. So I certainly think it's very related, to the economists. In terms of the second part of your question, Doug, and that was a panel question, or not a panelist question, so it's from consumers. So I'm teeing up the next chart from that perspective is, kind of what do we see? And to start with, this is consensus expectations here as of mid-December, that growth is still going to be, above trend line, but starting to fade as this year progresses. Part of that's that $3 trillion in government spending going to $1 trillion. But inflation, which was the gist of your question, that's where you're starting to see some benefits, from supply chains, maybe easing up and just lower expectation that inflation will come down. So this is consensus. Where we come out is, I think there's a risk here that growth is lower than expected, so that you trend down towards that 2% level a little bit quicker than anticipated. But inflation, as we've discussed a couple of times, remains stubbornly high. Maybe it's more overall in the 3 to 4% range, not expecting, quote, stagflation or super, high or hyperinflation, but it may stay stubbornly high based on that. Part of that story is just relating to the change in Fed policy. And so we've talked about a little bit the most accommodative policy, zero interest rates. The Federal Reserve was buying $120 billion, dollars of securities every month through, much of last year. In November, they started taking that off the table. December, you've seen a further pivot in terms of accelerating the balance sheet or stopping quantitative easing in terms of adding to their balance sheet. And they've started to set the expectation for interest rate hikes this year. Interestingly enough, this is a chart that we did for the outlook from December 22nd, was basically saying 3 interest rate hikes for the Federal Reserve. The market was similarly at 3 interest rate hikes, 3 more for the Federal Reserve next year compared to 2 to 3 for the overall market or expectations from economists. Just got an update this morning. It's not, now we're talking about our consensus expectation for the market is 4 this year and 3 next year. So that's in essence 1 more in each of the, the next 2 years. And so all the liquidity that we've discussed, whether it's deficit spending or what the Federal Reserve has been doing, is going to change this year, which is going back to our forecast. There's a delay in terms of monetary policy and the impacts that has on the economy. but overall may take a little bit of the edge off the demand supply in terms of economic growth. At some point, it will likely impact inflation, but there's always a delay in terms of the inflation statistics that you see.
You know, when you talk about that change of expectation, I mean, that's in the last 3 weeks, you know, did the Fed wait too long? I mean, should they have done something earlier? Because we went from, you know, 6 months ago with the, you know, no real consensus on the Fed moving to, now it seems like every month this increased anticipation of raising rates has started. So did they wait too long?
Yeah, where have they been, would be the question. It seems like the business owners were talking about this long before the Federal Reserve.
Yeah, just to be clear, I'm not representing the Federal Reserve here. In my career, which you can now measure in decades, not years, this is the biggest mistake that the Federal Reserve's made, I think, in my investment career. So where were they last year from that standpoint? You know, we were talking about the 120 billion in securities, including mortgage-backed securities. As everyone knows, the housing market was hot. You know, last year prices were up 20%. Supply couldn't keep up with demand, and yet the Federal Reserve is still today buying more mortgage-backed securities to stimulate demand. You know, how does that make sense? You know, from our perspective, it doesn't. I think they're late, they're behind. They were banking on the participation in the labor market coming back. They didn't see the tightness in labor. They thought the economy still had a lot of room to grow before you're reaching an inflationary period. And I think they recognized here a month or two ago that they're wrong. And now they're pivoting. And so the question is, can they change their policy and still, you know, encourage growth, moderating inflation? Can they, you know, go forward with a soft landing type period? And the market's skeptical of that. I mean, there's skepticism. If you get it wrong, you're going to get it right this year or next year, you know, from that perspective, as you go through it. So we'll see. What we are saying, though, is this has an impact on financial assets. It has an economic growth impact and an inflation impact, but also, you know, in terms of what's happening within the bond market. We would say bonds are expensive. We talked about the 10-year Treasury back at the end of October, 1.4%, now 1.85% or so, as we mentioned. We look at it on a real interest rate basis, and once again, it's just the 10-year Treasury minus the core CPI. So the inflation has been running between 4 to 5%. What you see in the green area is the real interest rates negative 3%. We haven't seen that since the mid-1970s, when inflation was, you know, significantly higher than 10% during that area. So from our perspective, bonds are expensive and rates are going to rise. They already have last year. They are rising, you know, in the first, 2.5 weeks of 2022, and we expect that to continue. It may work out similar to last year, where most of the interest rate increases occurred in the first quarter, and then you kind of traded sideways, down a little bit, up a little bit. But we think there'll be a 2 handle on 10-year Treasuries some point, and it might be in the next week, not alone the next quarter, based on how fast markets are moving. It also has an impact on equity prices. So the low interest rate environment has been part of what's led to a price to earnings ratio, and NTM stands for next 12 months earnings, which is the measure that we like to look at in terms of the overall market. The current ratio here as of November 30th was almost 20 times on a valuation basis, or a price to earnings ratio, compared to a 15.5 times average. So the market's been expensive. We look at price to earnings ratios, also sentiment. So it's basically saying people are fairly optimistic about the economy. The corporate earnings grew, 35% last year, expecting to grow 10% this year. So the earnings environment, but also reflects the expectation that interest rates are going to stay, fairly low or only modestly climb from here. So we would say the overall market is pretty expensive, but there are opportunities within the market. So the best performing area is the U.S. market compared to international, compared to certain industry areas, but it's specifically large cap and large cap growth. So these are some of those mega cap companies, the Apples, the Microsoft, Google, Facebook, Tesla. The top 5 stocks now represent 21.5% of this S&P 1500 universe. And so you're seeing a lot of concentration. Those companies have performed well fundamentally, growing their sales and earnings. But you can see by the chart in the red, the price to earnings premium are 35 to 65%. But if you go down the chart in size, small cap, all the areas of the market are trading at discounts to their average. Mid caps, some of the areas are trading at a discount. The other tilt that we see in the portfolios is growth's been the place to be, from low interest rates, solid company earnings, information technology being 28% of the broad US market, but value looks a little bit more interesting. So those are your traditional financials, energy, industrial type companies. They're trading at discounts, so they're not frothy. You know, you wouldn't characterize parts of the US market as being expensive.
I gotta ask, because I know people are thinking it. We're looking at the Dow being, give or take, 35,000 today. Any bold predictions for where we're at a year from now?
I would say, I think the market will go up this year, single digit returns. So a lot of the easy money, the high returns has been made. And I do want to answer that question, Doug, to put it in perspective. So if you look at it back 95 years, and we look at it more on the S&P 500 or 1500, the market is up about 75% of the time. So every fourth year or 25% of the time, you have a down year. I would have said yesterday, if you had, or a year ago, if you had asked that question, that the odds of a down market were very minimal last year. I mean, you had great growth, recovery from COVID, strong earnings outlook, and all that liquidity. This year, less growth, more inflation, less liquidity. I think that's changed. So if you say on average, the market's up 75% of the time, I think my view, I'll probability weight it, is maybe 60% in an up year. There's a lot more risks out there today. The more the market goes up, the more I get nervous, about it. And that's where we are today, because the economic environment, the liquidity environment is changing, and we don't want to underestimate liquidity. Why are we not negative? If you look at, the Fed's going to increase interest rates. History would say that initially when the Federal Reserve hikes interest rates, that the market still goes up, from that perspective. It's only when you get closer to the end of that tightening cycle that you start to see some issues. Yep, that's true. What we would say is, well, we haven't started with 0 and 120 billion in securities. We haven't started with, the deficit spending. So does it impact or create more economic concerns earlier? What we do say is more volatility. When you get more volatility, which we've already seen in the first 3 weeks of the year, in essence, that limits returns. So last year we had a 4% correction. We're almost there. Today, we're over 10% in some of those growthy areas of the marketplace so far this year. So more risk, but yeah, I think overall my crystal ball would say, another positive year, but more risk that it's not.
And it could be something too with some of the statistics that Kurt has up there. It could be there may be different pockets. As Kurt said, we're favoring, small and mid value. The market has changed. When you look at the S&P 500 today, the top 5 companies make up almost 20%. And there's those, those stocks that Kurt mentioned. Mm-hmm. So again, growth stocks, typically, when you look at valuations, you're discounting future cash flows based on an interest rate if interest rates rise. So when you look today, talked about the market being off 4 to 5%. If you look at the NASDAQ, which is much more tech heavy, we're almost at a 10% correction. I haven't looked recently, but we're there. So that's why you could have headline numbers like the S&P maybe be up, 4, 5, 6, 7%, but you could see, financials, if rates rise, that's historically been good for financials. Real estate's another area, with cash flows, different segments of the real estate market, that it could be your S&P 500 looks a little bit different, but there may be opportunities. And again, we have a component of all of our portfolios that are indexed. We believe, you want broad market exposure, but in these type of markets where there's more volatility, the larger parts of the market, may face some headwinds. Active management, which is a good portion of what we do, may have a place for our clients.
So within the investment team, we're making changes, to the portfolio to reflect what has the most opportunities. Overall, what we are telling people, and this is our last chart, we have about 9 minutes left. And so I want to encourage some questions. So we'll be kind of brief with here to hopefully end with some of the last minute questions. But last 10 years, the returns have been great. Large cap, 16%. We're saying when we go through with financial planning for clients that we're going to be closer to 7%. And you can see similar stories within SMID-Caps, the most attractive area in our view. It's a little bit higher returns there, but less than the last 10 years. And so it's a little bit of an element of caution when we're doing the planning that, people have benefited from housing prices going up, their stock, 401k plans, the appreciation within their IRAs going up. But just as we go forward the next 10 years, as we move back towards those average valuations, we're seeing more limited returns within portfolios, pretty much across the board in major asset classes.
Speak to, I see, the chart's good here, and you referenced maybe an exit or maybe a capitalization on the profitability of large caps and moving away from large caps. So presumably to small and mid cap, and then also real estate. So when you say real estate, what does that look like? What type of, I cringe when I maybe think real estate, then I also think there's opportunity. Maybe for the panel and for my edification, specifically, what are you investing on that end?
Yeah, it's commercial real estate, but we use a mutual fund, to get direct exposure there. It's a global real estate fund. The fund really dislikes office and retail, and so some of those secular trends that we're experiencing, the work from home and office, the online trends that we're seeing taking business from brick and mortar retail is part of that story. And so this is a mutual fund that really focuses on industrial, apartments, medical. When they're looking at office building, they do more within the medical offices area. So diversification, and really it's investing in real estate that's benefiting from some of the secular trends. Part of that story is, when we're looking at it, how do we protect portfolios in inflation? Part of it is real estate. In general, we think with building costs being up, there's going to be less building going on. So from a supply standpoint, so we expect price increases for certain areas within the real estate area. We're also looking at commodities funds. So we're doing some areas, within our strategies, within alternatives, to also protect portfolios against inflation.
Thanks.
A question came up that we've had come up in the previous calls we do, and Kurt hasn't touched much on alternatives and where our exposure is, but a question came up in regards to cryptocurrency. And so it's been a part of all of our conversations. It was good timing towards the end of our presentation to bring it up. We didn't have slides, but one of those, tough questions for Kurt also.
I thought I was long-winded enough with my answers that we would be able to not.
Great question.
So, cryptocurrency, first of all, as an institutional advisor that works with institutions, individuals, we don't have the access or capability to buy Bitcoin or any other crypto on your behalf. So you have to go directly to Coinbase or some of the other procedures. The way we look at crypto is we differentiate between Bitcoin or other cryptos that are just focusing as currency or a store of value. We don't see Bitcoin replacing the US dollar, the euro, the yen, the renminbi. We think central banks will come out with their own digital currencies here in the next few years. And so we're not positive on the future of Bitcoin. Yes, they'll replace El Salvador and maybe Venezuela and other countries that are seeing hyperinflation. But we don't see as much value there in terms of a currency. It's costly, it's volatile, transaction costs, et cetera. What we do find interesting, though, is utility tokens and other cryptos that are supporting blockchain technology from that standpoint. So there's a lot of areas, the decentralized finance applications that will impact, banking, for example. But there's a lot of interesting, developments going on. There's been a lot of talent that's left some of those mega cap Apples of the world to become software engineers for startups and improve the blockchain technology. It's a little bit early. It's unregulated right now. That's going to change. If you listen to the SEC and the chairperson talking about, so there's more regulation coming. If you look at Bitcoin in particular, it did run into difficulties and from a price standpoint when the Federal Reserve was last increasing. So certainly this liquidity has flowed into cryptos. So how we're evaluating is more, it's an emerging technology. We're not there yet. From advising clients to invest directly, but watch, the tokens and the cryptos that are actually going to become, if they're not already, industry disruptors in different areas.
Yeah, when we look at it, like any, investment, while it's hard for us to institutionally gain access and on behalf of our clients, having a position, a 1% to 2% position of your portfolio may be reasonable. The thing is, when it falls in that speculative space, it's got to be money that, it could go from, it could double or triple on me, or it could go to zero. And that's the thing about cryptocurrency. There's thousands of them out there. Bitcoin with the biggest name, I'd say the second biggest name is Dogecoin, which has no utility or no value. I mean, it's a meme investment. And so you buy Dogecoin because someone else is going to buy it from you later on a higher value. That's not typically how we invest, but it's worked for a number of people. But again, any investment in as a part of a diversifier across your portfolio can make sense, as part of that. So again, not something, we've got a number of clients that own it. It's, probably not widespread in kind of our client base, but we do have a number of clients that own it. Just make sure you kind of understand what the risk reward trade-off is with that. So.
We've got one more question. Perhaps we can address it. I think both of you, I think would be great. And then we can close out. But aside from the reversion to the mean or as an alternative to large cap stocks, are there drivers behind the expected outperformance from the small and mid cap stocks?
Yeah, I would say historically, that area has seen faster earnings growth. And so we think it's attractive now because of that relative valuation discount, but also historically about a 1% higher earnings growth. So you can, see and experience better growth. The negative in small caps, it's not without risk, is that, higher interest rates, more, smaller companies, they're not going to the capital markets and seeing, fixed rate corporate financing from that standpoint. So, that's kind of a little bit of an offsetting factor. So we haven't talked about the international. That's been an area that's disappointed in returns. A part of that has been the U.S. dollar. The U.S. dollar has been consistently strong, over the last decade. Some expectations with, our inflation, the twin deficits, that the dollar could be weak and that could change that standpoint. Economists have been expecting that for the last few years. It hasn't happened, so maybe take that with a little bit of a grain of salt. But that's also another area. So I think overall what we're saying from the investment team is diversification from that standpoint. Chasing what's worked the best over the last few years or last 10 years, that's in general, we don't see that replicating, over the next 10 years.
And a couple of things when you look at, focusing on maybe Europe specifically, their makeup of their market looks a little different. We're much more tech heavy. They're much more cyclical oriented. So if we see this rotation out of techs really leading the charge with rising interest rates, the structural nature of the European stock market may have a benefit also, that some of those, they definitely are carrying lower PE ratios, which historically they have. But if you do see a rotation out of tech heavy to more cyclicals, you could see that be another reason why you would see some better performance out of international markets.
Great. Good to wrap up. Stacy, Kurt, thanks for your time, and I appreciate the answers to the questions. And thank you all that attended. I would offer, this is another program within our Business Insights series, and we have another one coming up in February that will be focused on our business advisory services. So certainly be on the lookout for that, and we hope you can join us. We think that's going to be valuable. And again, another thanks to the panel, and thanks to all that attended, and I appreciate it.